Good evening, ladies and gentlemen. We welcome you all to our First Capital's third research conference. We'll be starting proceedings in about 5 minutes time at 3:05 p.m. And we will wait a bit for the participants to log into the system. Good evening, ladies and gentlemen. We welcome you all to our First Capital's third research conference once again. Uh, I would like to introduce myself first. I'm Dimanta Matthew. I'm heading research at First Capital, and joining with me is Achyutan Srirangan, the assistant manager of First Capital Research. This is our third research conference that we are doing. Actually, we used to do two conferences during the year, one at the start of the year with the strategy report that we launch, and then we do a media outlook around the July period. However, this year we had to delay proceedings because of the COVID-19 outbreak that was there, and also due to the uncertainty that was there in the system. However, with that, we had to actually delay it to September, and we've at the start of the month, we've actually already launched our media outlook. And you can check our media outlook and all our reports from our website, firstcapital.lk. All our reports are uploaded on the website. And to take you through the proceedings for the evening, I will hand it over to Achyutan. Achu?
Yeah, thank you, Dimanta. And for today's presentation, we have a two-part. The first part, the 45 minutes, we are doing the presentation, me and myself and Dimanta. And the second part is going to be the question answer session. And for the people who can post the question in the Zoom, actually, don't use the chat, use the question answer section. For then we can go through the question and we can answer you. And the second, people who are watching us on Facebook Live, and you can put the question also there. We can take up the question when the question answer session starts. And people who to want the question at the latter part, we'll do the question answer session. Thank you.
So let's share the report at the start. Slowly. So starting off with the proceedings, as you can see, Media Outlook 2020 is what we are presenting, and our theme for the evening is W-shaped recovery. That's what we are going to focus on. And if you take our report, the report will be divided into three different sections. Firstly, we will be looking at our track record, what has happened over the last 9 months, what have we recommended, and then how has the recommendations performed. Then on the second part, we will be looking at what the outlook for the evening is, how are the numbers, what are the factors actually are likely to affect us during the next 12 months. And then finally, we will be going into the recommendations. So starting off, first section, we will be looking at the track record. And we will start off with the bonds. As we recommended in January 2020, we were looking at a rather bearish outlook from second quarter onwards. However, towards the latter of the first quarter, we had to go through the pandemic, the COVID-19 outbreak. And with that, what happened, we had to actually, with the uncertainty that came out, we had to go through multiple revisions of our report. So we did one revision immediately in early April. Then our second revision came in May, and we had to do a third revision in June. So this is mainly because of the uncertainty that was there in the system and the continuously changing situation. As you know, we didn't expect for a longer extended lockdown period as we went through, and with that, and with the measures that the central bank constantly took, we had to continuously change our expectations. And with that, we expected, in line with our expectations, the 1 year fell by around 300 basis points, while the 5-year and 10-year came down by around 250 basis points. So at the moment, if you look at where the yield curves are broadly in line with our expectations. However, we are also expecting an additional another 50 basis point rate cut to happen. However, the yield curve has already adjusted to that rate cut as well, as you can see in the chart on the left hand side. So with that, what we believe is we have been fairly accurate on this front. So looking at the next slide, uh, if you take the bond yield bands, we did 2 revisions in May and June, and here we had to what we mainly did was bring down our bond yield bands. You can see our fixed income health score, where we see that with the pandemic situation, with the COVID-19 coming in, immediately we had to revise our expectations, and our revised expectations were that there's going to be a significant increase in our fixed income health score. And with that, we were expecting we brought down our bond yield bands twice, once in May and once in June. In addition to that, if you look closely, we've done another change. This is we've actually increased our spreads between the 1 year and 5 year, and also the 1 year and 10 year. So 1 year and 5 year spreads we've increased from 100 bips to 150 bips, while the 1 year to 10 year spread we have increased from 150 bips to 200 bips. So this is another change that we've done during the period, because of, though the health score increased, we noticed that in the future it is likely to significantly decline, and the future risk is likely to come down. So with that, we are increasing the mid-tenor and longer tenor spreads. Straight away, if we go into the banking rates, we were expecting banking yields to come down significantly in line with the 5-year bond. We've been fairly accurate on this front as well. So we expected the bond yield bands to, the banking rates to mainly, we track the AWPLR. So we expected the AWPLR to come below 9% and also follow the 5-year bond. However, we didn't put renewed revisions for the banking rates per se, but what we put out is the revisions for the government securities, the bond yields. Going into the exchange rates, immediately with the COVID-19 situation, we actually revised our exchange rates, and we expected a major depreciation in the rupee. So we were targeting the June to be 190 to 194 range for the rupee, and the December target was 198 to 203. However, with the situation, the government enforced import restrictions, and with the strict import restrictions, the depreciated currency immediately appreciated, and with that situation, we actually did not revise our expectations, because we were expecting the import restrictions to be temporary. However, the government took forward the import restrictions and even took measures to extend import restrictions to a further 6 months. So in this ground, I think we can clearly point out that our expectations have been inaccurate, mainly due to the import restrictions that were imposed during the period. If I go into the equity market outlook, with the significant tax concessions that the government gave in the month of November, we were expecting a major boost in the stock market. We were targeting the SPI to hit a range of 7,500 by the end of the year. However, immediately after the COVID-19 outbreak, we revised our expectations, and expecting a major hit, we brought down our targets to 4,600 to 4,900 range for the year end. However, with the measures that the central bank took and back-to-back rate cuts and the SRR cut that was implemented, we saw that there was going to be a significant decline in interest rates, and the companies were invariably going to benefit out of it, especially the banking sector, to name a few. And with that, we immediately took measures to upgrade our ASPI target again from 5,200 to 5,600 range by the end of the year. So our final recommendation has broadly been fairly accurate. However, if you take the whole gamut together, we feel that our accuracy has been mixed on these grounds. So this is the section that most people or investors have been waiting for, especially our viewers. So we will straight away get into the factors that will affect the mid-year outlook. We will be looking at the period from June this year to July in 2021, that period. For ease of taking the presentation forward, I have divided it into three sections: political, economical, and external factors. So let's start off with the political factors. On the political side, we are expecting, we've already attained political stability. So this is a positive outlook for us. So looking at the next slide, what we are mainly looking at here is, with the political stability, I think there is some amount of policy stability that has been established. So as we expected, from after the November elections, as we mentioned in January, we expected the same results to follow in the general elections as well. And with that, the ruling party was likely to win the election. And however, if you take the August elections, which was delayed from April, the ruling party has got 2/3 majority. This is an achievement that no government has ever achieved in the current preferential voting system. So with that, you can say that political stability has been established for a 5-year period, and with the executive and the legislature coming off the same party. And with that, we feel that there will be provincial council elections that is likely to immediately follow. And with the provincial council elections also is likely to follow a similar fate of the general election and the presidential election. And we feel that the ruling party is likely to win majority of the provincial councils. So with that, we will further ensure the policy stability that we have achieved at the moment. So let's look at the economic outlook. So we feel that the economic outlook is rather neutral, mainly because there are signs that we are in for a tough period. So let's straight away get into our theme of the presentation, W-shaped recovery. Now, why do we say a W-shaped recovery? See, if you take this year, we've actually downgraded our GDP target from 1.4% to actually minus 5.8%. A steep downgrade, mainly arising out of the first quarter's GDP results, where we were expecting somewhat of a positive GDP growth figure, but then we got a negative figure. Achyutan will explain further on it. However, if I proceed, we've actually are targeting a major dip in the second quarter with the uh, with the strong lockdown that we had. And however, if you take the following year, you can see that what we have put actually is a subdued growth figure, just 2.8%. So with the significant CBSL volumes that is there in the market, which we will explain as the presentation go on, and also the uh, inevitable relaxation of import restriction that is likely to occur, we are likely to go in for a currency spike. And also the currency crash is likely to be followed by an interest rate spike as well. And this is likely to give another shock. And that's the reason why we are not looking at a V-shaped recovery, and we are more or less looking at actually a W-shaped recovery. To explain the concept further, I will hand it over to Achudan, who will take it forward from here.
Yeah, thank you, Dimanta. And we see a lot of people are talking about a lot of shapes of recovery, starting from V, U, L, K also. But we in Sri Lankan context, we are going with a W-shaped recovery. It's mainly with our GDP, and because when we revise our third revision in May, and then we got a first quarter GDP as a positive GDP. But what actually came out, the first quarter we saw a minus 1.6 with that, and we revised our second quarter and third quarter GDP. And because second quarter GDP, when the period is 51 days a long lockdown, and those period a lot of companies and a lot of business are closed down, and we feel with those lockdowns and the whole GDP can't grow in a second quarter, and we put a percentage of 16 and 19% degrowth for the second quarter, and third quarter onwards, and we might see the slower growth. But fourth quarter we put a minus 0.8 and 2%, because import restriction currently prevailing in the market, which may be relaxed in the fourth quarter. Because when you need a GDP growth, if you are controlling the import, you can't grow, because 70% of the whole Sri Lankan GDP is a consumption. If you are controlling the import, you can't grow at the moment. That's really reflect in our this year GDP. The final figure is coming like a minus 5.8 due to the second quarter hit. For when you are moving to the next one, because this year we are predicting a minus 5.8% growth, but normally when you have a lower growth in the one period, the following period we might see a high growth. But we are not going to see the high growth, because import relaxation, which we feel that will relax whole in the fourth quarter of this year, might be dragging to the second quarter or first to second quarter of next year, which will lead to the lower growth. And as Dimanta mentioned before, the W-shaped recovery is coming with a currency crash, because when you are releasing import restriction and when you are going to settle down your CBSL holding, there's a more pressure on. And with that, you can't grow the Sri Lankan GDP for next year also. And with that, and we come across with a 2.8% for next year and 3.2. That's a very low figure. For these all are the problems, the fiscal problem what we are having, that will delay our recovery in the GDP. For the next one, when you come into the export import, and with the change of COVID-19, change the mix of our goods import and export, and with the import restriction, and we saw a heavy degrowth or the minus growth in our import. But when you take export, and we dropped only till April and May, and we recovered June and July, and we might see that might get slowed down because the import is most the needed for the some kind of export. And when you take the service export and import, service export mainly coming from the tourism, and for the tourism for the 5 months of this year, we are not having any sort of tourist, zero tourist. And with that, we can't improve the export there. But when you see the service import there, and we are the lockdown of airport and closure of airport, which lead the leakage of the service import also. And the primary income, we might see the same figure as the last year, but the worker remittance, what we got is a net here. The worker remittance also same as export, we are seeing a growth. But worker remittance mainly coming from the Middle East, because a lot of people are want to return back to Sri Lanka. People who save the money in there, and the channels what they are sending the money to Sri Lanka, because with the lockdown, it's like back into the small way, they are sending the money. For the last 4 months we see the growth, and we feel for next few months it will be slow down in the worker remittances. And worker remittance, why we are seeing a net actually here, because some foreigners are who are working in Sri Lanka who have remits their foreign their salary to the foreign also. That's also very considerable amount, 600 to 900 million per year. For that one we are not seeing any sort of decrease. For that's why we are feeling the worker remittance part will hit by the 31%, and mainly the import restrictions. And for that's the main thing for the goods import. For that's why we are seeing a 40% growth. And following year, the 2021, we feel the import restriction removed, and we might see the spiking in the goods import. And when the relaxation of the tourism happening, and we can see the service export also will improve. And with this all, and we might see a balance of payment deficit for this year is going to be a $1.8 billion, and which is mainly because we can't the deficit, we can't settle the money with the, because the foreign debt raising is very hard in this situation, because one side our sovereign is spiked in the after COVID-19, now it's coming down, and now with the sovereign payment which are going to have in next month also affect our foreign debt payment. And the next year we feel, for when they are going to have a budget in November 2024 next year, after that we might see a foreign agency will come to the foreign lending side, and which will reduce our balance of payment for next year. And with that we're having a finance gap surge in this year, because this year first 7 months we are seeing a huge budget deficit, because government lost revenue due to the import restriction and mainly to the lockdown. And we feel this year government is going to have a, like Sri Lankan government have a 10% GDP budget deficit, and which is mainly funded through normally it's funded through the foreign and local 50%. With this, because we can't access to the foreign funding, and that will mostly funded through the local funding. And when you move to the next year, we might see a less budget deficit compared to this year, but it's considerable very high, because normally we have a budget deficit of 4 to 5%, but next year we are going to have a 5 to 7% budget to the budget deficit to GDP. And for these are our foreign currency borrowing options, and for that's also limited. And for, because this year we having the 6 billion worth of foreign debt payment, but government expect to borrow 5 billion. And but for now, so far the government, the 5 billion, they only secured only 2.4 billion for the first 7 months, and mainly coming from China. And we have another funding lines called IMF and rapid financing facility. We feel mostly it will come after the budget. And next one is a China debt coming from the Chinese Development Bank. We feel that's already part of it came into the Sri Lanka. It's 500 million. We feel another 1 billion it's need to come in from China. And another bilateral loan, it's mainly for this ADB and World Bank, mainly coming for the project loans. That's also 1 billion. And finally swaps, and swaps mainly we are working on India for 1 billion to 1.4 billion, and we got a 400 million swaps already. And for these are our funding lines so far, what we predict Sri Lankan government can access for next 12 months. And with this, and we feel after the payment of sovereign also for this year, we feel our foreign reserve will, with this pressure, will come to 6 billion. And then we feel the next year with these funding lines all are that will come to the 6.5 billion. And for with this, and we have a debt repayment, and how the government going to support their local budget. For now, I'm going to hand over to Dimantha to further explain on that.
Yeah. So let's now look at the debt maturity profile. if you look at next year's debt figure, you would see that we are now next year's debt is going to be in excess of 3 trillion rupees. So this is local and foreign together. In rupee terms, it will exceed 3 trillion rupees. This is a very high figure for us. Usually over the last 2 to 3 years, what we've seen is the debt raise, our total debt for a year was in the range of 2.2 trillion to 2.4 trillion. However, next year we estimate that it will exceed 3 trillion rupees. And if you take the debt to GDP, it's slightly below 90 at the moment. And we feel that during 2020, it is likely to hit 96% and then move in excess of 100% by end of 2021. So let's look at the breakdown of this overall debt situation. So if you take the bonds alone, I'm going to take here the government securities or the treasury bonds, SLDBs, Sri Lanka development bonds, and the sovereign bond, all three together. If you take the all the local and foreign bonds together, our repayments are closer to around 1 trillion rupees in terms of rupees, that is. And then if you look at the breakdown, if you take rupee bonds, is about 340 billion. Then SLDBs we have in excess of 1 billion, around 1.2 billion dollars. And then we also have a sovereign to repay $1 billion around October, to be exact, on the 20th of October. Now, if you look at the quarterly breakdown, what we see is that high level of debt to be repaid on the fourth quarter of this year and second quarter of next year. So fourth quarter is mainly the sovereign that we have to repay, and then during the second quarter of next year, what we actually have to repay is mainly the SLDBs. And what you need to know is we have not shown the third quarter of this year, next year. In July next year, you have to have repay another 1 billion sovereign bond. So we are going into a period of high debt repayments. So in addition to the 1 trillion of bonds that we have to repay, if you take the bill stock, our bill stock has exceeded 1.2 trillion. So as you know, it's less than 1 billion, less than 1 year stock that is there. And what we are seeing at the moment is when we are rolling over debt over the last few months, we've been rolling it over on the shorter end. So with that, you would see that our debt stock compared to the overall treasury bills and bonds portfolio has now exceeded 20%. So this is the highest figure that we've seen over the last 5 years. So basically our treasury government securities portfolio duration is actually shrinking. So with that, you have another 1.2 trillion coming out of the treasury bills. And then the balance, if you look at, we have around 0.8 or closer to 1 trillion of project loans to repay. So that is also mostly foreign currency borrowings. So with that, you can see that usually we have in the range of $250 million to $350 million range monthly project loan repayments to be done. So that is on the debt situation. If you look at again on the foreign reserve side, in addition to what Achyutan mentioned, the foreign reserves over the last couple, if you take this year, has come down significantly. However, over the last couple of months, we've seen a spike. That is thanks to the dollar buying process of the central bank. So with the import restrictions, the rupee was appreciating. There was pressure for the rupee to appreciate, and because of that, central bank has been over the last 3 months continuously buying dollars. So with that and supported by the 400 million currency swap, we've managed to push up our foreign reserves position to 7.1 billion dollars. However, let's look at the foreign currency debt repayments. If you look at what we have mentioned here is from July this year to June next year, the 12-month period, we have about $5.6 billion of foreign debt to be repaid. And you can see that since we have not been raising foreign currency loans, our repayment cover has significantly come down back to 1.2 times, similar to the 2018 situation. Yeah. So then looking at the liquidity position, if you remember, we've had continuous back-to-back policy rate cuts, and with that SRR cuts. And due to the SRR cuts and the lower credit growth in the system, we've had a significant spike in the liquidity position. Also, you can see that there has been a rise in the CBSL holdings, especially in between February and April. And up to date, we have closer to 300 billion rupees of CBSL holdings. With the CBSL holdings also and the lower credit position and the SRR cut, we've seen a significant spike in the liquidity position and is maintained up to date. And with that, we are coming to the credit situation. I will hand it over to Achyutan to take you through what the private sector credit position we are expecting.
Yeah, thank you, Dimantha. For the private sector credit growth from our third revision, we revised back this year, because third revision we put the minus 1.5% and we revised back to 6%. So this is mainly coming from the low interest rate. The people have a more demand for the credit. People will go for the credit actually. But what we thought, it's not happening actually in the last 3 months, because last 3 months we see a negative credit growth till July, and for the June and May we have the high deficit. That means the people who settle already, the private sector credit growth, it's narrowed. And with that, and we feel with the relaxation of import restriction, which is going to happen in the fourth quarter, and the low prevailing interest rate will be trigger some sort of credit for a consumption basis. For that's why we feel it's a 6%. 6%, it's roughly around 300 billion. We already have a 35 billion worth of credit growth, and for more to go for 270 million to get a 6%. And with the 6% growth we are going to have this year, we reduce a 1% for next year, because when you're having a bit higher credit growth than what you expected, we downgrade or we decrease 1% for FY 2021 from 13 to 12%. For this is mainly on the back of the import relaxation. What we are going to have in fourth quarter will be followed in the first 2 quarters of next year. We might get the half of it or more than the private sector credit growth for the next year will be in the very first few months of next year when the rates are prevailing low. With that, and we are coming to the inflation. Now the inflation is under control, and for it's mainly that's hovering around the central bank rate of 4 to 6%, and we feel the interest rate will be in a lower because of the lower the base year is lower for last year, and the next year for a 6 months. For this year, base year is going to be a lower, which that. And we are going to have a low inflation. But you can see in the 2 boxes whether we are going to have a shortage of the food supply. And for the first graph, November to January for this year now, but to next year January, we are not going to see a much sort of pressure on the food side. And but after the currency crash, as they mentioned in the presentation, if we feel the currency crash on the second quarter, which will create a cost push inflation, for that will trigger and that will push the interest rate, and that will push the inflation rate also to more than 5% in the second quarter of next year. When we summarize of the whole economic indicators for next 12 months, we have 4 positive and we have 4 negative. The first thing is GDP is slowly but gradually it's growing. And for that's a one positiveness, because we are going to see a positive GDP growth. Second, high liquidity, because we have a liquidity but low credit, but high liquidity sufficient to support the credit growth. And third one is a low lending rate. Low lending rate will be for sufficient to get a more credit, and low interest rate will be good for the economy for the growth. And finally, the inflation, as I mentioned in my previous slide, inflation under control, no more pressure from there. But same as a 4 positive, and we have a 4 negative. It's a mainly high budget deficit I mentioned before in my previous slide, and that increase government borrowing. It's a both foreign and local. And second, CBSL holding surge, as Dimanda said, it's 300 billion, and we have more than 300 billion now. That will trigger a rupee depreciation in the due course. And finally, we are going to have the third one. We are having the next 4 years, and we are going to have a high foreign debt prepayment. Mainly, it's coming from 4 to 4.5 billion capital payment coming from 2020 to 24, as most of the rating agencies mentioned. And finally, we are very difficult to raise a foreign debt. And because the most of our budget deficit, as mentioned before, are 50% foreign and 50% local. But for this budget deficit, most of the things are funded by the local borrowing. With that, we are coming to the stance of the economy outlook. It's going to be a neutral stance. And with this, external, it's weak, but with the lower foreign holding, because external sector what we are having is a neutral, and this is mainly is coming from after the COVID-19, and back-to-back rating agencies starting from April to May, back-to-back they downgraded because mainly coming from a fiscal deficiency and plus the high debt prepayment we are going to have for next 3 years. With that, they downgrade our rating, and with the current scenario of financial gap, as I mentioned before, with that we might see a potential downgrade starts when we are not done the fiscal consolidations. And with this, how the foreign inflows are moving to the EM market, because after the COVID-19 triggered, and most of the monies went back to US or Western countries. But after the second quarter of this year, we are seeing the funds are coming back. You can see in the first chart, the March, it's $100 billion went out from EM market, but June and July, we are seeing a small sort of improvement. But that's mainly coming from EM market, not into Sri Lanka. But in the meantime, in the last 7 months or 8 months, we've seen both bond and stock market see a foreign outflow continuously. But last 2 weeks, we are seeing a small, the foreign inflow to the bond market. That's not significant. But in the stock market, we are seeing a more than 38 billion rupee worth of the stock are sold by the foreigners. And the third one, we no need to worry about our foreigners holding a government bond. We are having a less than very low. It's the historic low level. It's around 12 billion. We are not going to see any sort of pressure from when the foreigners are selling a government bond in Sri Lanka to moving on. We are not seeing a much risk. With that external outlook also, we are coming to the neutral stance. And for this, with this, and for the political outlook, as they mentioned, we are seeing a positive economic outlook, and external outlook we are seeing a neutral. And with this all stance for this for the next 12 months, and we are taking overall outlook as neutral. And you can see from your right hand side the time period. Last 3 time period we are seeing 1 positive and 2 neutral together, and we are running this economy. And with this, we are going to see the same ripple effect also for next 12 months. And for further recommendation, I'm handing over to the Imanta from this stance, how we are going to make a recommendations.
Thank you, Akshadan. Let's look at what most of the viewers have been waiting for. So we are going into our recommendations, and we will start off quickly with the bond recommendations. So in line with our stance, where we expect some pressure on the bond yields towards the first quarter of next year and beyond. So this is not a new recommendation. We have been extending the time period when as to the bond yields might move up, mainly because of the COVID-19. We have been postponing it and revising our recommendations continuously. However, now with the uncertainty being cleared out, we are looking at some sort of pressure for bond yields from first quarter 2021 onwards. Reasons we are looking at. One is high foreign debt repayments during the year of 2021. And then secondly, high budget deficit that we are having. We are looking at 10% budget deficit this year, and closer to 7% next year. And with that, what is going to happen is the government's borrowing requirement is going to spike, and due to that, if private sector credit also pick up, there is going to be competition for borrowing, and with that we feel that there's likely to be more pressure for yields to move. And the third and final reason is that trade deficit may grow wider with the import restrictions being lifted, and then with the consumer demand coming in and higher imports, we may see some pressure on the rupee on that front as well, and then there could be pressure on the foreign reserves as well. So let's look at the fixed income health score. So you can see that over the next 12 months, we are expecting our health score to significantly come down. The main area we have to look at is the Jan to March period, where we believe that the risk levels are medium high, and also the April to June period, where we feel the risk levels are quite high. So let's first look at the short-term outlook. Now, short-term over the next 1 to 2 months, we have a contrarian view. What we expect actually yields to stay low or even come down, mainly because if we've had negative credit growth, and if August credit growth is also very low, we feel that very low or even negative, we feel that there is a chance of that additional 50 basis point rate cut that we have been mentioning at the start of the presentation. So with that, for a short period, there could be a dip in rates, and however, that dip does not come without risk. So there is a risk also likely to come with as soon as credit picks up, there is a likelihood of rates coming back up again. However, also you have to know that on the central bank or the government side, they have the option of increasing the CBSL holdings if they really require to keep rates down. So money printing is an option which can later have repercussions when it comes to next year. However, this year there is a very high possibility that yields are likely to remain low and may even come down for a short period of time. However, as I said earlier, towards the from the first quarter of next year onwards, we are expecting rates to move up. We are looking at 50 basis points to 100 basis point increase. Mainly, however, if the import restrictions are lifted, it will get accelerated. However, remember that if import restrictions are further delayed, there is a possibility of the upward pressure being quite slower. So you can see that our 80%, 85% probability is given for bond yields to be bearish from first quarter of 2021 onwards. and we are looking at 1 year in the range of 5.5 to 6.5, and 5 year 7 to 8, and 10 year 7.5 to 8.5%. So what we are looking at is towards the first quarter, within the first quarter for the bond yields to touch the bottom of the bands and then move towards the upper bands towards the second quarter of the year. Let's quickly look at the banking rates. So banking rates, we feel that banking rates are likely to remain below 7% until private sector credit picks up. However, after that, we feel that it will hover in a range of 7 to 8%. Now, if you noted that we've actually, AWPR has touched a very low figure of 6.25% as at last Friday. And so this low level is likely to be retained until credit growth picks up. So let's quickly move into the exchange rate, and with that what we are looking at it, the exchange rate, we are having a larger spread. So you can see for next December what we are looking at is 186 to 191, and for next June 195 to 210. So usually we don't give this large spreads, but since we are not sure when the import restrictions are going to get relaxed, we've actually had we put in a larger spread. Now if you look at the bottom bands, it's 186, more or less somewhere closer to the current currency figure. So that is mainly because if the import restrictions are persisted up to December, we feel that 186 figure is the likely mark, and it is unlikely to appreciate because central bank will be looking at absorbing the excess dollars that come in simply because in order to build the reserves. However, next year you can see that we put a significantly high spread, so we are expecting a gradual relaxation of import restrictions. Obviously, if the import restrictions are fully relaxed, 210 is the figure that we are looking at. If it's relaxed in a gradual pace, obviously it will be somewhere in between. So finally, let's look at the equity market. Equity market is significantly benefited with the political stability that is there. You can see political stability brings in policy stability, which allows brings in confidence for long-term investments, and which equity market being a long-term investment option is a significant beneficiary. And with the back-to-back rate cuts being given and the SRR cut, we had to upgrade our previous stance. So the dip in earnings growth has been marginally upgraded. That's one of the main reasons why we have upgraded our ASPI bands as well. So this is mainly because you can see with the uptick in the decline in rates, there are bond profits for the banking counters and huge decline in finance cost for the manufacturing companies. So with that, there's a major benefit coming in. So for next year, we are looking at from second quarter onwards, beyond the first quarter, sizable earnings growth figures coming in place. And if you look at the annual outlook, you can see that for 2020, we are looking at a dip of 22%, down, upgraded from the minus 26%. And for 2021, we are looking at an earnings growth of 19%. So with the significant decline in interest rates and FD rates coming to a range of 5.5% in the banking sector and finance companies coming around 8.5%, what we are looking at is equity market has become a very attractive investment option. So this is a recommendation that we have actually put out in July 2020. What we are showing here is we are maintaining our stance that there's going to be a strong market returns in the equity market due to this situation. And what we are looking at is, so in July, we upgraded our bands of SPI from 5,200 to 5,600. We've been fairly accurate there. If you look at the now number, the SPI actually has exceeded 5,600 also. However, what you have to look at is how long is your investment duration. So in such a situation, you may have to take into consideration the 2021 valuations as well. So we are looking at 5,800 to 6,200 as the range of ASPI for 2021. So what I suggest to most investors in this case, in a period where the FY20 valuations have exceeded, is in the shares that you've bought, look at the targeted average annualized return. So if you can, and what we usually look at is the T-bill, 1-year T-bill rate plus 8% equity market premium is what we put at. So from around 4.8% to we put a 8% premium, equity premium, and 12.8% is the figure we are roughly looking at. So if you have an average annualized return of expected return of above 12.8%, it's a good investment to go ahead for the next 1 year as well. So with that, you can see that if your stocks, the returns are lower than that, then you should be reducing exposure in those stocks. So you can see that sooner the index comes to the 6,000 mark, we suggest that equity market exposure needs to be reduced. However, if it's significantly lower, and we suggest that you need to increase equity market exposure. So we come to the end of the presentation. So currently what we are going to look at is what are the positives actually that could prevent our 85% probability. So what are the extraordinary events that could occur that would completely reverse our expectations? So if there is another shock to the system, like similar to COVID-19, that could be a trigger point to completely change our view. So it will make the 85% probability irrelevant and make the 15% probability that we have mentioned more relevant. So in addition to that, what if we have a 2 to 3 billion foreign inflow during the first half of the year? If you're looking at the full year, we may need around $4 to $5 billion of inflows. However, first half of the year, if there is a sizable 2 to 3 billion foreign direct investment coming in, it may completely change the scenario. In addition to that, on the external front, if such sort of fundings come in, our external outlook could also change. And with that, we make, if we can persistently gain such inflows, there could be a outlook change for Sri Lanka as well. And if such a rating change or fund flow change occurs, that could also significantly change our view. So finally, we would like to remind you our theme again. W-shaped recovery is what we are looking at. And with that, I think we can go into questions. I would like to give it to Achudan to remind you how you can send in questions again. Achudan, over to you.
Yeah, thank you, Dimantha. And the people who are in Zoom, actually, they can go to the question answer session in the bottom, and they can post the question. And we already got a few questions, more than 15 questions already there. And then for these reports, again, you can download our First Capital research report in our website. In our research section, you can find this report, and you can find our, after the COVID-19, we did a banking sector and we did a stock updates and all. You can find those reports in our website. And first, we have the one question asked from us mainly, Dimanta. They're asking about the health score, and for that's 3 or 4 people asked how to calculate the test score. What the health score means actually?
Yeah. Okay. Yeah. So if you look at our fixed income health score, we've actually divided the health score into 2 separate sections. So we take into account 11 different criteria to calculate the health score. So we have a priority criteria where we take into account 6 key criteria. So you will have the net foreign holding that in government securities, the net foreign inflow that we are looking at, it could be credit growth, inflation, are some of the key criteria that we look at, and the foreign reserve position, one of the main things that we look at. So these are the main criteria that we look at, and we allocate about I think 75 points.
75 points.
75 points for the priority criteria, and then you have the secondary criteria coming in place. We look at the external outlook, how stable is the rupee, what is our rating outlook at the moment. Those are the main things that we look at in the secondary criteria. Is there any other?
For secondary criteria, mainly on the foreign exchange side and all, how the rupee traded in the particular time. And for this one, we are monitoring each month actually, and we are seeing the past data, and we are calculating for the next 12 months to figure it out where we were, and which discussed in our lecture, the slides also, and we mentioned and we forecast for the next 12 months how the economic health score. With that only, we are getting our bonds rates actually.
Yes, actually that's a key element. So it's not exactly on past data that we forecast. So once you have the past data, we actually forecast 12 months ahead what the inflation, reserves, all the key criteria, and then build this health score on that. And then based on that, we give a health score. So basically, if the fixed income health score increases, that says that there is a high possibility that interest rates could be coming down in the future. And if the fixed income health score is actually deteriorating, then it shows that there is going to be pressure in the future that rates could actually move up. We can go to the next question.
For the second question, the market really have any justification on CSC, and corporate earnings dried up in Sri Lanka last 4 to 5 years. And what happened in the last 5 years for an investor exiting market and good sound on market? For this question, some people ask about the market, and they ask about the bond market also, why foreigners are selling. That's mainly the foreign selling part.
Yeah, Ashudan, I think you can take up.
Yeah, for the last 5 years, from 2015, and we saw continuous back-to-back taxation and the policy changes, which affect the company's earning, because company's earnings, when you see the last 5 years, company earnings are continuously downtrend, and for especially on the tax rate, it's changing within a quarter. Also, they change the tax rates, and for with that, and foreigners are not consider about the policy, because they need a solid policy for next 2 to 3 years to hold a stock. That's why, and the foreigners are sold, and for that's mainly happening on the stocks. When you come to the bonds, And for the bonds, it's not a new things for the foreigners are selling, because foreigners are selling the bonds for the last 2 years. And when the rates are down, they start to sell actually. And for now, we are seeing in a low foreign holding, that's a 12 billion as mentioned in my presentation. And low, we are in a low. And we think this foreign buying will come again to the bond after the second quarter of next year, when the W-shaped recovery, the last end and currency crash, then only we might see the foreign inflows.
Exactly. Now, so what is happening is basically with the uncertain period, it's not really per se Sri Lanka we're looking at here now, what the foreigners are looking at. So with the uncertain times, we are seeing a significant outflow from all emerging markets into safe havens like the dollar or even gold. That's why gold prices are skyrocketing. So with that, we are seeing a significant outflow, especially in the bond market. The equity market also, the outflow is continuing. And if you look at a possible range of inflow, what we are looking at is now with the import restrictions and the high CBSL holdings, even the foreigners understand that at some point the currency needs to readjust with the high level of CBSL holdings, or the CBSL holdings needs to be absorbed by increasing debt from the government. So basically the government raising higher debt. So with that, what we feel is that if there is a subsequent currency shock and an interest rate spike, and at that point of time would be a highly suitable period for the foreigners to come in. So at that point of time, we feel that foreigners will start to look at Sri Lanka, possibly first looking at a sovereign bond. Remember, we have a sovereign bond to pay in October and in next July. So our rates are still high and very attractive. Once we pay the July sovereign bond, most probably from our reserves, our rates are likely to, for sovereign rates are likely to come down. So it's a gradual process. With the buying interest increasing and the risk coming down, we may start to see foreign investor interest coming into Sri Lanka. It's similar to bonds and similar to equities as well.
And for someone asked about we mentioned about the W-shaped recovery, and they're asking recovery, what W-shaped recovery within what period? And they're asking the period of W-shaped recovery.
Yeah, so if you take the W, there are two V's in it. So we feel that as Achyutan earlier mentioned during the GDP explanation, we are in the first phase of the first V, or in the initial phase of the W, I would say the first V. And then we expect another shock towards the second quarter of next year, where we will be going into the second section of the W. So with that, what we are looking at is a second shock bringing down the economic growth, and then a gradual recovery happening after from the third quarter onwards, so beyond the third quarter. So with that, what we are basically looking at is, if I make it more clear, what we are looking at is an upward trend in W. So the second shock that is likely to come in may not be as high as the first shock, where we had a 3-month lockdown period. And even if a lockdown period occurs, now people are more used to it. They know how to get things done during that period. We have a work from homes happening properly. So with that, though there is some sort of a shock, people are used to it and they know how to get things done. So because of that, since we have had a prior experience, our second shock or the second bottom is likely to be higher than the first bottom. So we are more or less looking at an upward trend in W.
And for one question from Dr. Naveen Gunawatha, he's asking what is your rationale for negative growth in Q3 2020, and with the same thing with the GDP. And for that's coming from Ritik Shivakumar, he's asking like 2021 is the GDP growth is very low, but with the base effect kick in 22 also, why rationale is low? And for the first question I am taking on the Q3 for because of the mentioned before in our presentation, when you're having restrictions on import and you can't have a growth main because the in Sri Lanka, as I mentioned before, it's the consumption is a main driver for the growth, and plus the government stopped or they hold lot of the public funding project, and with that all we can't see a growth picture for the third quarter because like lockdown period finish on May and the companies are slowly resumed, and for the third quarter we might see a plus, but we might see the minor growth with the restriction. And for the second question, just pass it to Dimanta regarding
also adding on to what Achyutan explained. Even if you look at the third quarter, you can see that the first half of the third quarter was very slow. Sri Lanka took a long time for things to normalize. Even school starting was normalized very recently. So you can see that business activity really started to pick up towards the second half of the quarter. And also keep in mind that we also had a scare of a second wave coming in during the middle of that period. So when all this kicks in, we feel that third quarter also 50% of the third quarter is impacted. If we look at the year 2021, what we are looking at is, see, we were mentioning a W-shaped recovery. So there is going to be a second shock that we are looking at towards the second quarter of next year. If you look at all the previous years where we've had such currency shocks, I can give you examples of 2008, 2012, even 2016. The follow in a year of such shock, things significantly slow down. So because of that, that is one of the major reasons that we are having subdued growth during 2021 also, and also why we are putting on a higher budget deficit. Why we are putting on a higher budget deficit for that year is also government will have to take further additional measures to treat for that shock. So we are actually covering that section also during 2018. 2021. So with that, we are looking at only 2.8% for next year. So you have a high budget deficit, you have higher borrowing requirement. Second half, your interest rates are going to be very high. So second half GDP growth for next year, we are looking at it slightly being onto the lower side. And then from there on, we are going to have a gradual recovery. So it will depend on how fast the government will take action, how fast the government can go to the market and raise funds. If they can raise funds well ahead, our recovery will be much faster.
And for just regarding one question regarding two questions regarding banking sector, first one from Dilshan Fernando is asking, will the banking sector able to perform continuously as now in the next 6 months as well? And for with that question, I'll join with the moratorium, this thing also, and how the moratorium, this thing, and the banking sector.
Another question on the moratorium.
Yes, moratorium.
Actually, why don't you ask the banking sector?
Yeah, for the banking sector, we feel the first thing, the low interest rate, and because most of the banks having bond holdings, right? And when the low interest rate, the bond holding portfolio will give a mark-to-market gain to the banking profitability, and mainly the banks which are give moratoriums which are going to end in the September, and we feel that after the September the low interest rate, those loans will get a reprice, or those roll will get a roll over, and for with that we are not seeing a huge effect on the banking sector, but for the 6 months we are not seeing a much duplication. But when you take the finance sector, another the part of the NBFI, non-banking finance sectors, for this moratorium, this thing will hit, because there's a segment for the mother can explain further on the non-banking financial segment how the moratorium will affect them.
Yeah, so basically what is happening is if you take NBFI sector, they are significantly impacted by the moratorium, because the second tier of clients is the segment that NBFIs look at. And when we were covering the sector, we had a number of meetings, and most of the problems in these finance companies is that when they talk to their clients, they are not sure whether they can actually start paying back, because as after 30th of September, if we actually look at now, it's very close by, business have really not picked up, and then we have the import restrictions going on. Most of the companies do not have stock in order to sell, so there are huge problems going on. We have the import restrictions on vehicles. You can see the MBFI sector, 90% of the loan book is related to vehicles, and then you have credit growth, credit actually contracting in this MBFI sector. So we are expecting actually NPLs to spike close to 20%. And similarly, banking sector will also have a impact with the moratoriums. However, if you did notice, during the first half of the year, most of the larger banks have already started to provide in a big way. So with the bond profits also coming in, that is partly set off by the huge impairment provisions that they've done. So second half, especially the larger three banks, right?
Yes. For Sampath, commercial HNB, we are more bullish because they are the one having a more bond portfolios, especially commercial bank bond portfolio around like 300 billion they are keeping in bonds.
Yeah,
and
in addition to that, if you look at actually the impairment provisions during the first 6 months, the larger banks have actually significantly provided, which is better off for them going into the second half of the year, and also beyond that also, because if credit growth is picking up, banking sector will have the benefit, and if the interest rates are picking up, bank NIMs will start to increase again.
And one more question, because we answered the question in our presentation, is asked about, can we expect further rate cut in this year?
Yes, the key thing to look at here is the August credit number. That I think plays a major role here. We feel that the August credit number also might be negative. Private sector credit growth is what I'm talking about here. So if private sector credit growth is negative during August as well, that is a key element to look at, because what other measures can the central bank take to boost credit? What we feel is that at least one more, probably the last rate cut could be on the cards with that situation. Actually.
And then like we go into the next set of question. It's asked about, because we mentioned about our 2020 target of market is around 5,400 to 5,600. The few question asked about ASP today is 5,780. Is it overbought?
Yeah, so that question, you would have felt it also today in the market. We saw a bit of a resistance starting to come into the market in selected stocks. So I wouldn't say all stocks are overbought, because if you take the banking stocks, I think most of the banking stocks are actually then undervalued, right? Trading at 70% or 65% of the
Yeah,
book value,
for
right?
the banking sector, because when you take a banking sector, actually it's trading around, as Diman said, is 45 to 60% of the book value, which is like 5 years ago, its banking sector trade above 1.3 times of book value, still cheaper because some banks are trading half of the book value, still have a more growth
So
on that.
main reason is that if you take all the banks across the board, the ROEs have actually significantly come down. However, with things normalizing, we think this will have another boost. And also with most of the larger banks having high level of liquidity, there is no real reason for them to go into rights issues as well. So their ROEs are likely to increase. So with that, we feel that the banking sector itself, which is about 40% of the market, is likely to re-rate. So similarly, you can say that there are a lot of fundamental stocks in the market which are undervalued. If you take the overall market per se, since the market has gone up on a consistently for about 11 days now, I think you could say on technical grounds that it is somewhat in a overbought position, but what you need to look at is individual stocks. Right?
Yes, and few questions regarding, because why the earning reviews of some companies covered by us are not released. That's not us, because CSE not released, and that's why we are not done the quarter results report. And for Dimad, you can give an explanation why the delays happen in the quarterly earning.
Now, what is happening is most of the companies have applied for the extension. CSE and SEC together has granted extensions for releasing of results. Now, we did the December results update a couple of months back, I think. And if you look at the March results, 4th of September was the last date to release results. And now only the results have been released. So most the industry, if they are looking at doing quarterly results reviews for all companies, they can only look at it now. And if you look at the June quarter, the results, the deadline to release results is was on the 14th of September. However, again, SEC and CSE together has granted extensions wherever companies have applied another 1 month extension, which means 14th of October is going to be the deadline for them to release results. So June quarter quarterly results review can be done after 14th of October. Yeah.
And then a few questions about the import restriction, and one person, it's like person name is not mentioned, is could you explain how import restriction have impacted on specific sector? And for another question, same question, like for what are the factors can take into the lift to the current import restriction, and what are the sectors can benefit? And especially because when you're having a, because import restriction there mainly on vehicle, because when you take a vehicle for each year, each month we are getting a 200 to 300 million dollars of vehicle import, with this restriction for mainly hit to the finance company, because finance company the 90% business is coming from leasing. Actually with this restriction they can't do a leasing business, because that's we government saying around we have a 1.5 billion worth of stocks actually, but when you had a meeting with the finance company, they are stopped the business of leasing, because like a lot of, not only the motor car, it's a bike, three-wheel and all, for those segments are got affected. And for the tourism, we don't have a tourism for last 5 months, and which the tourism sector also need a much import goods for to the cater the tourists. With that, the restriction is it's fine now. When we are going to open a tourist, most probably on the second half of fourth quarter, or like November, and we might need to relax some sort of import restrictions.
think the rubber industry, you missed out. How
For
will the rubber industry
for
fare?
the for because rubber industry, because Sri Lanka, what we are producing in Sri Lanka to match the market or supply to the market, it's very limited. And because like what we are doing actually mostly we are producing in Sri Lanka. When you are producing in Sri Lanka, cost of production is very high compared to the foreign. If you can bring the tires from outside, you can sell for a cheaper. That's not only tires; it can go up to tiles and all, because the protection like saving those companies, right? What will happen? You can get a cheaper tile or tire from the foreign. With this import restriction, those are the sectors getting benefit, and for those are the main sectors.
Yeah, I think the natural rubber segment has actually benefited due to these import restrictions. I think even the synthetic rubber prices have actually moved up globally. With that, natural rubber prices in Sri Lanka also is on its way up. And with that, some of the rubber plantations are actually benefiting during this period of time.
Yes, and few questions are coming on a W-shaped recovery, and for because like it's happening, do you expect a W-shaped recovery to ASPI too?
Yeah, well, actually, so it depends on how fast the ASPI moves up. So if it moves up too fast, yes, of course, because you have to understand if the SPI moves up significantly, so does the valuations. However, the earnings outlook will take a bit of time. So at the moment, we feel that the index still has upside to go to, because even next year, you can see that our band for next year is 5.8 to 6.2. So now this year is almost over. So we should really be looking at next year's target. So we have we can look at a 15-month target. So our upper band is in that is closer towards 6,200. So if you really look at there is a further 10 to 15% upside in the whole market. So with that, we feel that so what you can understand is if during the first quarter itself or during the fourth quarter of this year, if the index target is achieved, obviously then valuations are high and we are looking at a W-shaped recovery for the market in that sense. However, if the uptrend is gradual, then there is we can go up to that range. So what you need to really look at is where you need to reduce exposure. If you do in such a situation, then you can maximize the returns without actually losing money.
Yes, we are getting a lot of questions like what I did. I will summarize those questions. Mainly like for they're asking the could you provide more detail with regarding your expectation regarding tourism sector? Expect tourist arrival, expectation of airport will be reopened for international travelers.
Why don't you take that out?
Just as mentioned before, it's a airport opening while be the government informed yesterday for mostly happen on the fourth week of October. And with that, and we need to wait and see that pass into the task force for this thing, and we need to see how the things will happen. And for this, the sector, we might see a positive, because most of the companies are now, like most of the hotels are giving a hefty discount for the local tourists actually, because they are break even with the local tourists. And with the reopening, and hotel might be get a full with, because Sri Lanka is portrayed as a safe haven, not for the money and for the tourists now, because we are not get hit with the COVID-19, and we are still in the safer zone for the most hotel. And we are the one of the countries with compared to the Japan or the Japan tell the Sri Lanka is one of the top 5 countries that travelers can travel to Sri Lanka the safe because of the COVID-19.
So with that, I think they mentioned, they put a cabinet paper recently, I think, where they are looking at allowing flights to come in to the Mattala airport. So that is what we are looking at. So around November, end of October is where airport might get reopened, is what we are looking at.
And next question regarding what is the impact on the exchange guaranteed bond, that bonds and the foreign investor planned by the Nevrad Cabral, and both rates and FX.
Want to take that up?
Okay, the foreign investors, because foreign investors, let's say I mentioned in my slide the EM market, the emerging market, the mainly when you are the sovereign rates are very high, it's very rarely the people come to the local bond, because local bond having a exchange impact also, because we are normally last 15 years we are seeing a 4% depreciation in our currency, which will give the current lower rate in our bonds, which will giving a 2%. Bonds are trading around 5 years around 5 to 6%, and which will give you only the 2% net interest. Then that they can put in the dollar denominated sovereign bond, which is giving a more yield to them. And rarely they'll come in the low interest rate regime to the foreign and forex. And the forex have two impact, because when you are having when you are seeing any sort of second the V or W, second V, so 2V, and then when you are seeing a currency depreciation, foreigners will never come into the bond or stock market, they will exit before. After the currency depreciation only they will come. That's happened in 2012. If you see, within a very short term, our currency depreciated from 105 to 130. Yeah. And for the same thing, we are expecting in 2021 also.
So, to summarize, actually, we don't think that will have a major impact, because at the moment the sovereign rate is quite high. So we feel that what under normal circumstances, what a foreigner will do is first look at the sovereign bond, and as risk comes down, the sovereign bond yields will come down, and with that, if rupee yields move up, then that will start getting attractive, and then to get the higher yield, foreigners may look at taking that exchange risk and coming into the rupee yields. So first the sovereign yields, then the rupee yields. That's what we are looking at.
And one question: what do you believe a long-term expectation of interest rate, and will maintain broadly downward path over the next 5 to 10 years, or will be seen upward adjustment once again?
I think what we are looking at is so on a long-term horizon, what we feel is if you take the 1-year T-bill, a better range is around 9%. So we are looking at 5% inflation and 4% real interest rate, and so 9% is what we are actually looking at for the longer term, for the 1 year, and all other interest rates are dependent on that 1-year T-bill. AWPLR to the maximum FD rates for finance companies, every single thing is linked to that 1-year T-bill rate. So what we are actually looking at the moment, on the short term, I think there was another questions on where the AWPLR would be. So I'll answer together with that. On the short term, we feel that AWPLR will be below 7%, somewhere in the range of 6 to 7%. So the current rates would be bottom, is what we feel is. And then we feel that private sector credit growth will start to pick up now, because we've seen that there is again some interest coming into selected areas. There is interest in the equity market, then the property market is also slowly starting to get activated. So people are starting to take loans a bit, obviously the middle, upper and the upper segment. However, if the import restrictions are lifted, then there is more room for credit growth. And with that, we are looking at, so for the next 3 to 4 months, we feel that current rates can hold, and beyond that, we feel that rates will start to move up. However, if GDP is not picking up, we don't think the central bank or the government will like rates to move up. So we feel that different measures will be taken for rates to be kept at the current level. So we are looking at a 7 to 8% range for the AWPLR for the next 12 months or so. And remember, though bond yields move up, AWPLR won't follow immediately. It usually has a 6-month lag period. It didn't have that lag period during the downtrend because of the lending caps that the government imposed. However, in the upward trend, that lag effect will will come into effect.
One question came in chat actually. Shane Balaya expecting a credit growth of 270 billion for next 5 months. Where do you expect this growth is coming from? Shall take that question.
Yeah.
Because if you see the credit growth, the main months is March and December, and we always see when the low interest rates and March and December always have 100 billion, and we feel because when the low interest rate also will support a credit, and then when the import restriction released, and so many people will get a loan at a low interest rate, and they will buy a goods on white goods or vehicle, because mainly because when the currency crash or when you are feeling a pressure on a currency, people will, when the low interest rate, always people it's moved to the more into the vehicle. And the banks also, compared to the finance company, banks giving a leasing rate less than 10%, they will intend people to take a loan. That's happened in 2015 and 2014 first few months or first 7 months, the credit is minus. And the 2014 and 15 is mostly picking from the latter part of the year. For 270 billion, it's not a big mark to achieve, because 1 month 100 billion, it can be achievable.
Also, another thing to note is that once the second quarter GDP figure comes out, we feel that the government may have a different approach on the import restrictions. If we saw the GDP figures in India, we saw the GDP figures in Singapore in the 20% range, India 20% range, minus 20% range, Singapore minus 40% range. So with that, it's not way off Sri Lanka to be in the range of minus 16% to 19%, because remember, we had a much stricter lockdown than most of those countries. So and with that, if once those figures start showing, we feel that government may have a different attitude where they want to push GDP growth and let go of the import restrictions.
And we'll take a few questions for next 5 minutes. Actually, we have more questions, and we are summarizing and joining the each question. Like, please provide a recap, a break of 2.3 billion inflow Y2D. And for that question, I will take, because the foreign inflow, and for what I mentioned is a Chinese loan which came in the March, 500 million from a Chinese development bank, and 400 million swaps we got from in India, and balance all we got each year when we are getting project loan I mentioned before from the World Bank, ADB and all, those are the loans we got inflows. And for this is not enough to recover our foreign repayment, because this year foreign repayment around like 5.6 billion, and we only got only 2.3. We are shortage of 3.8, because we are going to pay our sovereign also from our reserve, and for this is not enough. And the one question regarding stock market again, do you think the economy reality is reflect in equity market sentiment? And the person is Raghu. I guess it's not. It's not. And low cost of funding creating a rally. What is your view? And he gave the answer in his question also. And because of low cost of funding, Dima, you want to take that question?
Yeah. So what you need to take into consideration is the investors' mentality, and also how we should be looking at. Now, there's no point of the current year being looked at, because with the 2 quarters already been shut out by the COVID-19 outbreak, obviously this year is going to be bad. But then stock market really looks at 1 year ahead. Then what we are looking at is a recovery. So, well, if it's bank, we are looking at the 2021 year. If it's other companies, we are looking at FY22. So how are the valuations in that? So the market is really looking at valuations of FY22 and 2020 or 2021 expected to really value the market, because it is impossible to value it on this year earnings, because there's a significant dip in the first couple of quarters. So in that sense, if you look at the recovery in a normalized year like FY22 and basically calculate it backwards, we feel that the market could be still undervalued even at this point of time. So I think at this moment of time, now we have only 3 months to go for 2020. So if you have 2020 December earnings expectations, I think we need to shift towards 2021 December expectations. So a normalized year, and in that situation, the outlook is much better, I think.
And we'll take 2 more questions, and so we can wind up this session. And one question is asked from Anonymous. Remittance have grown in last few months, and due to the bulk inflow with the repatriation, and since repatriation is ongoing, could the large fall in the remittance instead to be 2021 instead 2020?
Okay, you can take up that explaining why it has actually grown.
For just mentioned in my presentation also, that's the first explanation is the same as my thinking, because when the people are keeping the money there, because part of the money only they are sending home, and now when they are coming back, they are taking the whole money and coming, and plus the channels. And because when you are taking fund into your country, you can have different channels. And when the lockdown, as mentioned before, when the lockdown is happening, COVID-19, you need to take the money into the country, the legal channel, which is showing into the increase in the worker remittances. But what what the ADB predict on the worker remittances on the world, it's going to dip by 28%. But we are not seeing that kind of dip in Sri Lanka yet. After, just mentioned, after people are coming back to Sri Lanka, and you might see, and then you ask in 2021, and 2021, when the worker remittance, now we are shifting our workforce into the unskilled to the skilled labor, and for that skilled labor, when the economy is picking up in those countries, the remittance will be increased from that side to Sri Lanka. And the final questions for this is relating to the US, and what impact do you think the US election could have on Sri Lanka?
Yeah, so if we look at the US elections, if you take the past policies of US, now I'm comparing whatever side comes, what will be the impact for Sri Lanka. So if you take the past trend, over the years, what we have actually seen is US's strong intent to have much closer relationship with Sri Lanka. That's why these agreements such as MCC agreements are coming in place. So what we feel is that with the greater influence of China, we feel that US, whichever party comes into power, may show stronger intent to close up that gap that is there, where China is coming in at a much faster pace. I think similar worries we've seen from India as well. So with that, I think if we take it, analyze and take it well, I think we can really benefit out of it. So I will leave it at that.
And for that question, and if you have more questions, because we got a more question, I summarize it. And if you have more questions on to ask from us, you can reach out us through research at firstcapital.lk, and because we try to answer most probably for those questions as soon as possible after we receive. And for just hand over to
Yeah. So let's wind up the our forum from now. Basically, I would like to first of all thank all our viewers for remaining here and listening to our presentation and for forwarding us your questions. We've tried as much as possible to cover all the questions, summarizing up as much as possible. So we apologize if we couldn't take up any of your questions. As Achudan mentioned, we would like you to write to us to our email address research@firstcapital.lk, or even give us a call if you have any other clarifications regarding the presentation. So thank you very much.
yeah, thank you very much.